There are two chapters dealing with the calculations relating to the portfolio, right? Computing the risk and return part, and probably how do you interpret the risk and return of risky assets, and if I bring in a risk-free asset to that combination, what kind of impact that comes, and what are the various terminologies that come out as a part of the basic calculations in this portfolio risk and return calculation is what is being covered. So the first part of this is a very simple scenario where some part of it came up in quant, finding out the different types of returns, the holding period return, right, in multiple period, whether to use arithmetic return or a geometric mean kind of a return. These are again some portions that are repeated from there. But yes, gross return. What is the difference between a gross return and a net return in case of a portfolio? When we say any gross return, we are removing the brokerages or any kind of commissions, advisories. They are all typically removed. It's as good as saying, let's say, whether you are, even if you are a portfolio manager, right? When you have purchased the shares of something, after that you sold them, what you have actually got, you will get only after the deduction of the brokerage fee and the commissions and all whatever have to be paid. That is the amount that you are going to get. So whenever we use the word called gross return, we talk about after the deduction of the brokerages, especially those costs which are needed for transactions, not the fund management costs and all. The fund management and all are done by the fund manager. This fund manager is investing in the stocks, let's say, somewhere else, right? So they are invested over an exchange, and the exchange is charging some brokerage and or through a broker. The broker is charging some brokerage. Exchange is charging some transaction fees. All these things, they have to be removed, and a gross return is what is computed. Out of this gross return, if I remove the fund management fee, because I will charge something. See, there are three layers here. Clients are investing the money with the portfolio manager, right? Portfolio manager is probably saying portfolio manager is managing a client's portfolio. So client is giving money to the portfolio manager. The portfolio manager is investing. Whatever the return, the portfolio, whatever the cost the portfolio manager is incurring in the process, the difference is what, let's say he has invested 100 crores. The fund, the stock prices and all have gone up, and overall it has become 105 crores. But because of this buy-sell transactions, 1 crore has gone into transaction fees and brokerage charges. So what the fund manager actually got is only 104 crores. Right? The gross return is only 4% there. And what the client gets is what is the net return. So what is the difference there? The fund manager will say, oh, 2% is my fund management fee. Or annual fee is something. Some administrative expenses are there. All these things after deducting whatever the benefit the client is going to get, that is called as a net return. Whatever the benefit, probably look at it like this. Whatever the benefit the fund manager is going to get is what we call as a gross return. Fund manager or portfolio manager. Here let me use these two words interchangeably. Whatever is the benefit the portfolio manager is going to get is what we call as the gross return. Whatever the return the end client is going to get is what is called as a net return, because we remove the administrative fee, fund management fee. Fund management, because he is doing some research and lot of things, he'll charge something. Generally, it would be like some percentage of the assets under management. The total money, whatever the fund he has invested, let's say 500 crores he has invested, 2% of that 500 crores is what typically goes as a fund management fee. So like that, we look at the gross return versus the net return. And again, we have to define between pre-tax and post-tax, because whatever the benefit that whatever the profit that comes out, there is a tax that has to be paid on that. So we have to see whether that return that we are getting is before the payment of tax or after the payment of tax. Whether it is real or nominal. Nominal is it includes inflation also, but real means it excludes inflation. What is that return someone is talking of? Whenever someone uses return, these are all different ways of defining your returns itself. What is that return altogether? Is it a gross or a net? Is it pre-tax or post-tax? Right? If it is pre-tax, what is my post-tax return? Because at the end, what I really want is, as an investor, what I really want is, what is my post-tax nominal rate of return? Or post-tax real rate of return. One of these two is what I require. Probably I am fine with nominal also. Even if the inflation is there in the market, how much I am getting. Right? I am more bothered as a person who has contributed to the fund. My intention is, what is that I am finally getting after tax and everything, what is that I am typically getting. So whenever we talk about returns, because sometimes what happens when we look at on the websites of the fund management companies, they publish some return. It need not be a post-tax kind of a return. It may be a simple pre-tax return. So right, when they advertise, so they will mention that in small disclaimers, these returns are pre-tax kind of stuff. So you have to be very careful in judging all these things, all the worth of each of these funds. So that's where some understanding of these things is required. Then we also use a very good concept called leverage return. Today, we have the concept of margin. You only deposit some X money, but do the trading for 10x. Just by depositing, let's say 1,000 rupees with the broker, you can do the transactions worth 10,000 rupees. Because it hardly matters. The broker will get his commission for 10,000. Right? And it's like broker has given you a loan for the remaining 9,000. The broker has given you a loan, and he will set the system in such a way that if your total 10,000 is falling below 9,000, he'll do an auto sell off without you actually selling it off. The system will do an auto sell off and he will recover his 9,000 back. You're getting the scenario, right? Today there's a lot of trading that happens purely in a margin based. So look at it like this. Let's say you had 1,000 bucks, right? You have bought 10 shares of 100 rupees each. 10 shares, 100 rupees each you have purchased. Now let's say after 1 day or after 1 day, let's assume that this 100 rupees has become 102 rupees. So your 10 shares have become 1020. So you have got a profit of 20 bucks or probably 2% is your total profit. This is a normal cash based transaction. Now when I go with a margin base, what will happen? The same 1,000 which I have, I'll get into a margin trading. So what the broker will do, the broker will add 9,000 to it and say, now you can, I am giving you, now that you have deposited 1,000 as a kind of a security, I'll give you 9,000 as excess loan. So you can do your trading for 10,000 bucks. Right? So because he is doing a trading for 10,000, he can buy 100 shares of 100 each. Instead of 10 shares of 100, he can buy 100 shares of 100 each. Now the same, if it has gone to 102, right? His total money is becoming 10,200, right? Out of that, the broker's part is 9,000. You refund back the broker's part of 9,000. 1,200 is what is left. With the 1,000 which you have put, you have actually got 1,200. So you have got 20% return. That is what we call as a leverage return. The return which you are getting because of the margin trading process. Borrowed funds. After refunding whatever the borrowed amount, whatever you are left with, is what is called as a leverage return. Especially with the margin trading process, the total derivatives world trades on margin trading itself. But the same problem comes the other way also here. Right? If the share price instead of 100, it goes to 98, in a cash base you must have lost only 2%. In this base you will lose 20%. So leverage return is very highly risky compared to a normal return. But people play on that, right? So that is what we have to compute in some of the cases, especially when leverage is involved. Leverage is nothing but borrowing. The word leverage, especially when leverage is involved, borrowing is involved, whatever the return that I am talking of is my contribution of money, how much I am left with. Right? Because after I contributed something, someone else has lent me something. But for that party, once I refund back, everything else is mine only. Those are the returns which we call as leverage kind of return. So in a portfolio case, we have to understand all these kinds of returns because we involve in getting at each of these layers. Now, with respect to the portfolio, this is something which we have looked at in quant also, the covariance between the two securities. Right? We have defined correlation earlier. Correlation is nothing but covariance divided by the standard deviation of security A into standard deviation of security B. So we can define it. Let me put it into a spreadsheet directly. See, we have already defined earlier that correlation is nothing but covariance divided by the standard deviation of both the security. Standard deviation of A into standard deviation of B. So this is one important aspect that comes into the entire world of portfolio management. So probably what we'll do now is we'll take some example and first drive that example, then probably we can get back to the theory part. Let's say I am talking about two securities, A and B. A is giving a return of 20% and B is giving a return of 30%. And let's say the standard deviations or the risk that is available with A, let's say it's to the extent of 25% and with B it's around 40%. So I have, so higher the risk, the first thing that is coming out for us at this moment, higher the risk, higher is the return. So this is having a high risk, so probably it's giving a higher expected return. So these are expected return, right? Because it's having a high risk, I'm expecting that it will give me a high return. So probably it may go the other way also. But as an expectation, I'll show this kind of a return. And I'm also saying that the correlation between the two securities, these A and B, let's say is around 0.5. It should lie between -1 to +1. So I am just assuming that it is around 0.5. So based on this, I can very well compute the covariance. The covariance is nothing but correlation into the two standard deviations. So I am taking it as correlation multiplied by the standard deviation of the first one multiplied by the standard deviation of the second one. So overall the covariance is some 0.05 in this case. Now what I want is, if these are the only two securities that are available to me based on client analysis, blah blah blah, all the other stuff, let's say these are the two securities that are available to me. I want to find out what is the portfolio risk, what is the portfolio return. Individual security risks we know, individual securities returns we know, but I want the portfolio overall portfolio risk and portfolio return. For that, what I am looking at, okay, I'll try out different kinds of combinations. I'll try out different kinds of combination wherein I will invest some money in A and the remaining money in B. So I am taking some combination. Let's say I put 0% of my money in A. What if I put 10% of my money in A? Like that I am trying out, let's say, some kind of combination up to 100%. So if I put 0%, then in B probably I may have to put 100%. Right? So I am taking all these as different possibilities. Though there may be many other possibilities also, I am just looking at few of them. So probably I can, as an investment decision, I can go for a 0-100 or a 30-70 or a 50-50 or a 70-30 or 80-20, whatever it is. Now in each of these combinations, I want to find out the return of the portfolio and also the standard deviation, which is the risk of the portfolio. Or probably I'll call it as variance first, variance of the portfolio, and probably the standard deviation of the portfolio. These are what, so I want to see in which case the risk is higher, or probably how is my return moving with respect to the risk. These are what I am more interested in checking out. Now for the return of a portfolio, our formula is straightforward. W1R1 plus W2R2, which is nothing but a weighted average of the individual return. So in this case, the weightage W1 is this much multiplied by R1, whatever is the return the first one has generated, W1R1 plus W2, the remaining portion, into R2, the return which the second security is generated. So this is overall 30%. Correct, right? So because my 100% of my money is going only into B, so whatever is the B's return, I will get that much as a return. So obviously, if I am doing the same exercise, you see that the returns are lying between 20 and 30. Right? And they are more or less linear because it is W1R1 plus W2R2 is the typical scenario that is coming up. But when it comes to variance, our formula is different. This is the variance of the portfolio. W1 squared, the variance of first, W2 squared, the variance of second, plus 2W1, W2, the covariance between the two. So using that formula, what I'll do, I'll find out the variance here. W1 squared, variance of the first one. Variance of the first one is nothing but the standard deviation squared. The standard deviation squared plus W2 squared. This is W2. W2 squared into variance of 2. So the standard deviation of this square right, standard deviation of this square plus 2W1 W2, 2W1 W2 covariance between the two. Covariance is purely determined by correlation. Covariance between the two. So this is what has come out to be the variance in this case. And when I take the square root of this, it comes out to be the standard deviation. So standard deviation has come out to 40%, which is same as this. If I put 100% of my money only in B, the standard deviation will be the same as B itself. Now these two, when I am extending, what you typically see, let me convert that into a percentage form. What you typically see is the overall risk has come down from 40, you see 37, 34, 32. It has come to an extent of 24 also. And again it has gone up. Whereas in case of return, you see it's a constant drop. Whereas in case of risk, that did not happen like that. It happened slightly differently, which means the return always lies between 20 and 30, which is the minimum and the maximum, whereas the risk can be brought down below the minimum of the two also. That is what is the concept of portfolio management. If I choose a securities based on the correlation, now look at, probably if I choose a security that these, let's say between A and B, the correlation is minus 0.5 instead of plus 0.5. You see, you can bring down the risk even to the extent of 15%. Overall risk can be brought down to the extent of 15%, whereas individuals are 25 and 40. But return is still 20 to 30 only. That is why we are saying, for a small compromise in the return, if I can bring down the risk drastically, that is what we are calling as the portfolio, a good portfolio. So these are all various combinations of the portfolio. Some of them are good, some of them are not that good. If I am looking at purely from a risk mitigation standpoint, probably this is a better portfolio. I'll suggest my client directly, you invest 70-30. 70% of your money put in A, 30% of your money put in B. That is a better solution rather than putting all 100% in A or all 100% in B. Right? So this is how we calculate the portfolio risk and return kind of calculation. So sometimes we may have to play around with the numbers to say where is the risk actually coming down. We don't have a straightforward mechanism. So because probably I may say 71-29 may give slightly more lesser. Right? 70.5 and 29.5 may give slightly more lesser. So yeah, there are various other mechanisms of dealing with that kind of a mechanism. But what I am saying is, one thing which we have to understand from this part is, diversifying will reduce your overall risk, portfolio risk, without compromising too much on the returns. Now, if you see, probably if I have this combination, right, versus this combination, no investor with a brain will prefer the second one. Look at this. The risk is 25%, return expected is 20%. High risk, low return. Whereas in this case, risk is 15%, return is 23%. So no investor will choose the 100-0 at all. Right? So those are some of the advantages that we get. Or probably you see here, or try comparing it between these two at least, this and this. Okay, you are getting a return of 30%, but for that you have to take a risk of 40%. Okay, you compromise some 7% on your return. Your risk comes more than 50% down. Right? So it's like more value for your more value for the money. There's no, I mean, the chances of losing are much lesser, but you can still get your 23%. So that is what is an assurance, or that's what is a improvisation which a portfolio management is bringing to the table. Fine. So the basic calculations of risk and return computation here. Then when we talk about risk and return, we see we have to actually categorize the various asset categories. Like probably the equities may be more risky, whereas the government securities may be less risky. So we are calling them as asset classes. Classes are nothing but groups. So probably it's like this: small cap stocks, small companies, they may be more riskier than large companies. Or even in bonds, corporate bonds may be more riskier than government bonds. So depending on the risk level associated, we have to categorize the various securities into various asset classes. And apart from them, even liquidity plays an very major role in terms of the asset classification, because in some assets I can sell off whenever they want. Let's say equity is an asset class where I can trade whenever I want. Probably bonds, some bonds are very frequently traded, but some bonds are not traded too much. Real estate, the trading for equity is more common than a trading for a real estate. Probably today if I want to sell off my house, I cannot post it on the stock exchange, right? So the liquidity is much lesser for some kind of securities, some kind of asset classes, whereas for some of them it could be much higher. So the classification has to take into consideration that also. Even the normal behavior, like sometimes in some asset classes what could happen, the losses could be minimal, right? The skewness could be much higher. What does that mean? If you gain, you will gain heavily, but if you lose, yeah, you can lose many number of times, but small amounts. That's a skewed kind of a behavior. It's not that gains and losses are symmetrically distributed. Gains, if you get, they may be very heavy but very rare. Losses, they may be very frequent but very small. So even based on such kind of behaviors, you may have to group the asset classes. So the grouping of the asset classes is one major activity. And historically also it was seen that equities were showing higher returns and higher risk. Risk is measured by standard deviation. So equities were showing higher returns and higher risk compared to the bonds or even government securities. Then one important aspect that comes out from this analysis for us is we classify investors on three grounds: risk loving or risk seeking, risk neutral, and risk averse. Person who doesn't want to take risk at all, loves taking risk, and neutral. There are some calculations also on which investment has to be chosen if this particular investor is a risk neutral versus risk averse, that kind of scenario. Now what are these three? When I say a risk averse person, one, there is a dislike for risk. What does that mean? He is ready to take risk only when he is adequately compensated with extra return. It doesn't mean that he is not taking risk, right? The word has to be betterly used. When I say he is a risk averse person, by default, unless there is extra compensation, he will not look at taking that risk at all. Unless he is adequately compensated with that risk, compensated with an extra return, he is not willing to take the risk. Simple way of classifying these three. If there are two securities which are having the same level of returns, of which I am expecting they will give same kind of returns next year, right? The risk averse investor will choose the one which is having less standard deviation of the two. Risk seeking investor will choose the one which is having higher standard deviation of the two. Risk neutral investor, he can choose any of them. That is a simple example to classify these three groups of investors. When there are two investments with the same level of returns, risk averse guy will choose the one which is least risky out of the two. Risk seeking guy will take the one that is most risky out of the two. and risk neutral guy, he is indifferent between the two. So most of the securities pricings or anything, valuations and all, they go taking the risk averse investor because he is the most general investor, right? Unless, I mean, that's a very common tendency of the person also. I'm ready to take a risk only if I get something more out of it. If I mean, I don't want to take risk just for the thrill of taking that risk, right? If I'm doubly confident, or at least to a large extent confident that I will be getting much better return, only then I am ready to take that extra risk. That's the reason what we say is the any asset pricing or any valuation models, everything, they are designed based on the risk averse behavior of the person itself, right? Where they prefer less risk rather than more, whereas the risk loving investor, he prefers more risk compared to taking less risk. So he is fine, like a venture capitalist. Okay, he may be thinking that he will be compensated with a higher return, but he is still taking a very high risk. Even if it is losing, he is fine with it. Some kind of a gambling behavior is there in a risk-loving kind of a scenario, right? So one single example that can help us in doing. Let's say there are 4 investments that are available in the market, right? And yeah, here we have to bring in one concept called the utility of the investor. Utility is nothing but satisfaction level, right? The obvious scenario is whatever if you see here, the way the utility function is defined, the expected return minus, oh sorry, this is sigma. This is not R, this is sigma. Minus half A sigma squared, risk, variance, right? So return minus the variance kind of a part, which means for a risk loving investor, he wants the risk part to be much higher. So the subtraction should be negative for him. See, he will get more thrill, more satisfaction if the risk is more higher. Risk loving person, he takes very high risk. So he will always choose high standard deviation companies. High standard deviation means something minus the value. So the overall value should be negative for a risk taking kind of an investor. Overall utility should be positive for a risk averse investor, and probably close to zero for a risk neutral investor. You are getting the difference here, right? We are talking of return minus risk. For a risk averse, what are we saying? He is ready to take a higher risk provided the return is going to be much more higher. So the difference between the two will always be positive. The return risk, when I am doing a subtraction, extra risk is taken only if there is a expectation that the return will be much higher. So the utility will be much higher. Until that, he will not even bother to take a risk. Only if he gets quite a good amount of confidence that the expected return can go up, only then he is willing to take that extra risk. Otherwise, he will not take that extra risk. So the utility function will be positive for him. Whereas in case of a risk loving or risk taking investor, the utility function will be negative. And risk neutral, it will be around 0 itself. Right? So that is where we are talking of. Let's say the utility function, now taking these numbers for 4 of the investor, for 4 investments that are available in the market. 1, 2, 3, 4. Let me put it into a spreadsheet, makes things easier for us. So there are 4 investments that are available. So the expected returns for each of them, 18, 19, 20, 18. And the standard deviation or risk Now we are saying that the utility function is nothing but the expected return minus half times some constant times the variance of the returns. This is what is the in this case they have given this as an equation. This is what we are defining as a utility function. In general scenario also we define the utility function through this kind of a relationship. The expected return minus something times the variance. Right. So here what we are saying, let's assume that the A values this is the level of risk aversion. So let's say you take the A values as 2, -2 and 4. If you take the A value as +2, which of the 4 you have to choose? You take the value of A as +2. Now let me take the value of A as +2 for each of these 4 situations. Expected return minus half A. A I am taking it as +2 multiplied by the variance of the return. This is what? This is standard deviation or variance? This is standard deviation. So variance of the returns. This much. Expected return minus half into some A we are taking a constant 2. We have to decide now if A is high, whether you call him as a risk taking or a risk neutral, or who is that guy. So anyone, wherever he gets maximum satisfaction, he is happy. Satisfaction should be higher for that kind of a person. That is what we are simply defining. Right. Now you see, this is what is the number for first investment, second, third, fourth. So this guy prefers this kind of an investment. A person whose A value is 2, he is preferring this investment compared to any other investment. Right? Probably he is a risk. Now if he is having a value of 2, we can see he is a risk averse kind of an investor, because he is ready to take a 19% return, which is having a risk of 8%. So he is choosing, he is not a risk taking definitely. If he is a risk taking guy, probably it should come out for this. Right? He is a risk averse kind of an investor. Probably what you can try, just increase the number. From 2, let's say I make it 4. Right? Instead of 2 A value, let's say I make it 4. What is happening in this case now, you see? Higher value is coming here. What does this mean here? A very high risk averse investor, completely risk averse kind of an investor, he is preferring the investment 1. True, right? A person who does not want to take even a minimum amount of risk, he prefers the standard deviation of 2%. Right? So the utility function is telling him, if you are a very deep risk averse kind of a person, probably I will suggest security 1 for you. If you are a risk averse investor with a choice of 2, with a A value of 2, probably I may suggest the investment 2 for you. Now probably let's say if I am talking of a negative 2, instead of positive 2, I am taking a negative 2. Now what could happen, you see, if it is a negative 2, this is having very high. So what does this mean? I have to prefer this investment. So which means if A is negative, the highest satisfaction is coming for a risk seeking kind of an investor. So in this equation, simple logic for you, negative means a risk seeking kind of an investor, positive is risk averse kind of investor. High positives, highly risk averse. High negatives, highly risk taking. right? So from a typical risk return or risk aversion kind of function, you should be able to make out whether this particular person is risk taking or risk neutral or risk averse kind of a behavior. And for each of the person, now things are coming out which you have to choose. Probably in some other combination you may get security 3 also. From an exam standpoint, you may get the utility values, and based on the utility value you may be asked to find out whether he is a risk taker or a risk averse kind of a person, right? From the utility values you may have to calculate the A, and depending on whether A is negative or positive, you may say whether he is a risk averse or a risk taking kind of an investor. Then in this case, okay, now I'll go back to our example again. Now if we see the portfolio risk is actually coming down if the correlation is coming down. When the correlation was 1, the minimum risk is 25% of the portfolio. The minimum risk of the portfolio is 25% for a 100-0 combination only. But let's say if the correlation has become 0.5, the minimum risk came down to 24.74%. Right? Or probably if you are if the correlation is 0, the minimum risk has come down to 21.22%. So what is happening? Portfolio risk is coming down with the correlation coming down. As the correlation is coming, let's say it is minus 0.5, the standard deviation has come out to 15.5, or probably minus 0.9. You could even bring it down to 7%. The risk is coming drastically down. So which means if you are able to choose 2 securities in the market whose correlations are close to -1, you can create a scenario where the risk of the portfolio is 0. This is what the concept of hedge funds is. You create the combinations in such a way that the correlation between them is so negative, the risk comes down drastically without compromising on the return. Identifying such kind of securities, identifying such kind of transactions is what is the key role in case of a hedge fund. Right? So as the correlation decreases, we see that the risk of the portfolio is coming down, and if it is -1, it can even be brought down closer to 0 also. If the correlation is perfectly -1, it can so happen by doing some small, probably at 60-40 it may not, but 55-45 or 53-47, at some combination it will become 0 also. From the basic mathematics, it can become 0 if the correlation is -1 between the two. It's like almost 0 risk kind of a return. Right? And that's what it's saying. If the correlation coefficient is -1, the standard deviation or risk of the portfolio can be very well made 0 by picking the appropriate weights. Probably 55-45, 57-43, some place or the other. At one point, it can become a straightforward 0 if the correlation is -1. And if it is +1, no diversification benefit at all. That is also we have seen. If both are correlated, the minimum is 25 only, which is as good as invest everything in A. There is no diversification benefit at all. So the basic funda in any portfolio management is invest in those combination of securities whose correlations are lesser than 1. If they are 1, there is no diversification benefit. The more they are away from 1, there is a very heavy diversification benefit in the process. Right? Now, coming to our graph again, there are some minimal kind of interpretations that come to the graph. Let's say on this data, I do a small chart plotting where I do a plot between the standard deviation on the x-axis and the returns on the y-axis. I take the standard deviations of all these combinations on the x-axis and the expected returns on the y-axis and see the graph. Okay. So if I do that kind of a graph, all right, I'm adding the standard deviations on the x-axis and I'm putting up the returns on the y-axis. If the correlation is 1, I'm getting a straight line like this between the risk and the return. The graph between the risk and the return is a perfect straight line. Whereas now you see that the correlation, let's say, is 0.5. It takes a turn, it takes a curve, right? Or probably if the correlation is 0, the curve is even more prominent, right? This particular curve that comes out when you plot a line between, when you plot a graph between the standard deviations of the portfolio and the expected returns of the portfolio is what we call as a minimum variance portfolio, minimum variance frontier. What is that? Now in this graph, if you see, for each level of risk return, for each level of return, it is saying what is the minimum amount of risk you have to take. If you want 30% return, the minimum amount of risk you have to take is something which is this point. If you want 20% return, the minimum amount of risk that needs to be taken is this. If you want 25% return, because if you see, if you draw a line from the return, it intersects the curve at only one point. If you draw a line from the return, from the y-axis onto this curve, any point, it will intersect at only one point. What does that point say? If you want to get this much of return, this is the minimum amount of risk that you have to take. So it is so for each level of return, it is specifying the list of minimum amount of risk that needs to be taken. That's the reason it is called as a minimum variance frontier. Frontier is nothing but a line or a curve. List of all minimum variances. Variance is minimum risk. The list of all minimum variances for each level of return. So this curve is actually called as a minimum variance frontier curve. Whatever this curve that has come. Because for each level of return, it is showing what is the minimum risk. Minimum risk is minimum variance. What is the minimum risk that has to be taken? That is why this curve is called as a minimum variance frontier. Frontier is nothing but a set of joining of all the lines. Minimum variance, kind of a border. Minimum variance frontier, right? And that keeps changing depending on the correlation that is existing. If the correlation is -1, it is even more because the risk can be brought down drastically. It's almost to 0. So this is what we call as a minimum variance frontier. The list of all the, at any point you see, for a return there is only one point on this curve. For any point of return, let's say 20% to 30%, you choose any one point in between. there is one point that will touch on this curve, which is nothing but if your target is to get that much of a return, the minimum risk that has to be taken is this much. So that is the minimum variance frontier curve. And what you see is the x-axis is standard deviation, right? So whichever is the one to the leftmost side in this curve, that means the standard deviation is the least there, right? Because x-axis, left side, leftmost, is means the standard deviation is much lesser there. So at that particular point, the overall risk of the portfolio is the least. So probably you can say this is the point. The overall standard deviation of the portfolio is the least. So in this graph, this particular point is called as a global minimum variance portfolio. Out of all minimum variances, it is the universal minimum. So for this combination of A and B, if the relationship between them is minus 0.5, what I can say is the global minimum variance portfolio is a 70-30 combination. So for different levels of returns, there are different levels of risk. But overall, the minimum risk is at that 70-30 kind of a combination. So the whole curve, we call it as minimum variance frontier curve. Out of that one single point, which is to the extreme left on that curve, we call it as a global minimum variance portfolio. That is the one that gives the least possible risk out of all the combinations. And there is one more term that is defined in this context called efficient frontier. Now look at it, don't look at it from the return perspective, look at it from the risk perspective now, from this dimension. Let's say I am willing to take this much of risk. Now what is the corresponding return? I am getting two returns here. If I am willing to take, let's say 25% risk, I am getting two options here, this as well as this. Obviously, any commonsensical investor, for a defined amount of risk, he wants the maximum possible return. So, which means this portfolio completely will be useless portfolio. It's a complete useless portfolio because let's say from a person who is ready to take 25% risk, will you choose this or this? Obviously, you'll choose this, right? So, which means this is useless. So, whatever you see in the downward sloping area, they are typically useless or inefficient portfolios. From the extreme minimum, from the global minimum variance portfolio scenario, whatever comes towards the downward side, downward sloping kind of them, we call them as inefficient portfolios, and anything on the top, we call them as efficient portfolios. So that's where that portion of the curve from the global minimum variance to the upper side is what we call as efficient frontier. Out of the total global minimum variance out of the total minimum variance frontier, that upper portion, upward sloping portion of it is what we call as the efficient frontier, because the portfolios which are lying there, at least what you are seeing, higher the risk, the higher is the return. Only the top portion you see, from here till here, risk is increasing, return is also increasing. So that is a typical portfolio behavior. So what we are saying is, the ones from the global minimum variance to the top side, they are all efficient portfolios. The ones towards the bottom side, they are inefficient portfolios, and no one will go ahead even thinking of investing in them. At least the higher ones, depending on the risk taking level, I will choose. If my risk taking level is 20%, I may choose this. If my risk taking level is 30%, I may choose this. If my risk taking level is 40%, I may choose this. So different risk taking level people will choose different combination. But obviously the bottom part will be chosen by no one. So that's where they are called as inefficient portfolios, and only the top portion of the minimum variance portfolio is what we are calling as the efficient frontier. So what we are saying, just for summary, for each level of risk, identify the portfolio with the highest possible return. Though there are two possibilities, we are choosing only the highest one. So because most of the risk averse investors, they go with that combination itself. Right? Given two securities with same level of risk, any risk averse investor will choose the one that is giving a highest return of the two itself. Right? And most of the things we look at in finance from a risk averse investor standpoint, not a gambling investor standpoint. Right? We are only looking at a risk averse investor. So that's the reason whenever we talk about the efficient portfolios, we look at only the top portion of the minimum variance portfolio. So those are the points where there are no more benefits of diversification at all, because they are the ones that are giving me the highest possible return for a possible kind of a risk which I am willing to take. And you see that it is gradually increasing, the higher portion, it is gradually increasing, and probably after a certain point it will stable out, because whatever is the extra risk I am taking, my return may not be beyond something. So even that could stable out. And what is also important is the ones they are some portfolios are unattainable. Let's say I want to take very less risk, but I want very high return. Like in this case, probably this person wants to take 30% risk, but he wants 100% return, which are the portfolios which are above the risk free, above the efficient frontier. They are completely unattainable kind of stuff. For some level of risk, if I want very high levels of return, which is above the efficient frontier, whatever the points that I want to look at, they are all inefficient. They are all unattainable, right? Because that's the maximum return that I can get. For 30%, this is the maximum return that I can get. If there is a investor who is saying, I am ready to take a 30% risk, but I want 80% return, it is completely unattainable. Whereas below it, they are all inefficient. If I am ready to take a 30% and I want only 20% return, it's an inefficient. You can get it, but it's not an efficient thing. So when there is a better solution, why do you want to go for an inferior solution? So with respect to the efficient frontier, anything on the above side of it, they are all unattainable. Any points on the below side of it, they are all inefficient. Now we bring in one more concept here called as the indifference curve. What it says is, every investor, let's say you are a risk averse investor. For you are fine with some combinations of risk and return. Okay, 10% risk, 10% return. 12% risk, 12% return. 14% risk, 16% return. Some combinations, you are pretty much okay. Right? As a risk averse investor, what did we define? He is ready to take an extra risk, provided he is sufficiently compensated with the extra return. So I am taking the case of two sets of investors. One investor may say, okay, the risk is 10%, return is also 10%. Or probably risk is 12%, return is 13%. Risk is 14%, return is 16%. Risk is 16%, return is 20%. Let's say like this. So he is ready to take that excess risk as long as he is compensated with higher return. So probably this is a characteristic of one group of risk averse investors. Probably I may define another group of risk averse investors. Okay, for a 10% risk, he wants at least 12% return. For 12% risk, he wants 15% return. For a 14% risk, he wants 18% return. For a 16% risk, he wants 22% return. Probably he is also a risk-averse investor, right? Like that, what you may see is, for a combination of risk and return, we may see different kinds of risk-averse investors. So, this combination curve, whatever comes out, is what we call as indifference curve. This particular investor is indifferent between these four combinations. He can go with this, he can go with this, he can go with this, he can go with this. Because he is indifferent to all of them. He is ready to go with 20%. He is ready to go with 16% risk, provided it gives 20% return to him. So, all these four are equally okay for this kind of an investor. So, when I try to plot a graph, risk and return graph, I get a curve. That particular curve, for a particular investor, from an investor standpoint, now we are looking at the curve which joins the risk and return like this is what we call as an indifference curve. Because these are the 4 points. This set of customers, I am not talking of one customer, this set of customers, they are indifferent to. Whereas some other set of customers, they are indifferent to this combination. For them, for 10%, they want at least 12% return. If they have to take a 10% risk, they want at least a 12% return. It's very much possible, right? I mean, let's say for you, your combination is, I'm fine with this kind of return. Whereas someone else, his expectations could be much higher. So what you see is multiple indifference curves comes up when I look at the whole investor category. So I may say, I'll take less risk, but I want 10%. You may say you want 11%. The definition of less risk for me is 10% return, for you is 12% return, for him is 15% return. There's nothing wrong in that. So what we are saying is, this combinations of risk and return for different sets of investors, we are calling them as indifference curves. So on one side, we plot the indifference curves from a customer standpoint. From a security standpoint, we have an efficient frontier. From the portfolio standpoint, we have efficient frontier. From the customer standpoint, we have indifference curves, where these two touch each other. Because the customer's risk and return are shown in an indifference curve. The securities risk and return or the portfolio's risk and return are shown in an efficient frontier. Where these two touch is what is the optimal portfolio for that particular investor. So basically simplified, let's say the efficient the efficient frontier is on the higher side like this. Now when I look at the risk and return profiles, the optimal portfolios, I may get the indifference curves. Let's say 3 indifference curves are there. What does they? For a 10% return, this person may be fine with 11. For a 10% risk, he may be fine with 11% return. For a 12% risk, he wants a 14% return. For a 15% risk, he wants a 20% return. Whereas some other set of people, for a 10% risk, they want 14% return. So their indifference curve, okay, so if they have to take another 2% extra risk, they want a 17% return. If they want to take another 3% extra risk, probably they want 25% return. They are one group of investors. There are another group of investors. And now my security wise, the efficient frontier is what is giving me the risk and return combination of the security or the portfolio. Now where these two match or tangentially they cut each other, they touch, that is the optimal portfolio for that investor. So wherever it is touching, I may say this combination will be the optimal portfolio for this category of investor. So one, we are looking at from an investor's perspective, the risk, what is his risk versus return expectations, which are represented through indifference curves. On the other side, we are trying to map them with the combination of, portfolio combination. Which combination has what risk, what return? Wherever these two are matching, that is the optimal portfolio for that particular group of customers. So optimal portfolio, point on the highest indifference curve. That's a tangent to the efficient frontier. That is what we are. So it will differ for each investor because their indifference curves will be different. Because their indifference curve will be different. Corresponding to their indifference curve, wherever we are seeing a tangency with respect to the securities efficient frontier, we are choosing that combination as the optimal portfolio for that particular customer. Right?